Well, hello, everybody, and welcome to today's market update. I'm Greg Patterson. I'm joined with my teammates, J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management located here in Morehead City. This is our May market and economic update, and it's our fifth one in a continuing series this year. Each month, we strive to bring you to the latest on markets and the economy and give you our thoughts on where we are headed. And we do hope that these virtual meetings are valuable for you and your loved ones. And that's why we're doing them. So there's been a lot going on in headlines recently, and we're going to break some of that down for you guys today. As in past broadcasts, if you have any issues at all with technology, just stay with us. And we have not had any issues as of late, but if so, we'll jump back on the line just as soon as we can. And also, it's important for us to hear your feedback on these. So we'd like to ask you to send us your thoughts or comments. You can do that a couple of ways. You can always call us and let us know. You can, even easier, you can send an email to mackenzie@myatlanticwealth.com. And so her name is spelled MACKENZIE at myatlanticwealth.com. And we always appreciate your questions, your feedback, and your help with these webinars to make them even more impactful for you. Lastly, we continue to do these calls every month, and we invite you to share the invitations with your friends and family, your loved ones, those who you feel like might benefit from this. And that will help us, obviously, to share the data with those you care about. We will get these posted to our website. It's usually a couple of weeks after the broadcast, once our compliance team approves them. And then you can also direct your friends and family, those you care about, to the website as well. So we have a lot to cover. Let's go ahead and get started. Today, we want to go over an agenda of what we're going to discuss. As always, we want to look at current market returns. There seems to be a disconnect between what clients are feeling the market is doing and what is actually happening on those returns. So we're going to show you the real data and make sure that you have those current stats. Also, JA is going to go over the latest economic data. These trends tend to update every 30 days. Most of them do. And so this data will come to you pretty current. We also want to look at our U.S. recession indicators dashboard. It's always helpful for us to provide a perspective around the most anticipated recession of all time. We also want to talk about the leading economic index. This is put out by the Conference Board, and we'll share that as well. And then we're going to go off and talk about the debt ceiling that seems to be on everybody's news feed most recently. So we're going to give you our thoughts on that. And then artificial intelligence, also known as AI, and Chat GPT is another big topic that we seem to be getting a lot of questions and opportunity discussion around. And then finally, our financial planning topic for the month is going to be around estate planning considerations. And while none of us are attorneys, we do operate under some very important planning guidelines, and estate planning is one of those. So Tara's going to talk to us about that. And then lastly, we'll give you our conclusions and follow up. So that's a full plate today. With that, Tara, bring us up to speed on what the markets are doing.
All right, of course, this is exciting. Let's talk about the market. So the first chart that we're going to see here is the S&P 500, so Standard & Poor 500 year to date. So this consists of 500 leading publicly traded companies based on market capitalization. You're going to hear us quote S&P 500 often, as it's considered one of the best gauges of the U.S. equities market. So the most recent year-to-date low was towards the beginning of the year, and that was at around 3808. And I'm happy to report we've seen some new highs. Just before hopping on the webinar, the S&P 500 was trading at over 4,200. I saw that the market closed at like 41.92, so pretty close to that. So we started the year January, I mentioned around 3,800. We got up to 4,200. So that's a year to date increase of 9.8%.
That's unbelievable. Are you sure about that?
I'm positive. I calculated a couple times. So we're good on the math. We'll take a step back and take a look at the 1 year. Again, this is the S&P 500 index, the 52-week high. So looking at over the course of the year was over 4,300. That was actually in August of 2022. And then behind that in October, we actually dipped down into a low, a 52-week low at 34.91. And as I mentioned before, today we were trading over 4,200. So since that October low, the index is up significantly. Then we have the NASDAQ. So the NASDAQ index is another staple of our market report. This consists of about 3,700 companies, heavily weighted towards technology. So more than half of this index is technology stocks. NASDAQ had a year low in January at 10,305. And then the latest high was in February, but we've actually surpassed that. The last time we talked, it was in February. We've actually surpassed that recently, and we're currently trading above 12,700. And then the 1 year on the NASDAQ, the 52-week high was at 13,181. Again, like with the S&P 500, that was in August of 2022. And then the low, slightly different. The low for the NASDAQ was towards the end of the year in December. And so since the December low, this index is up about 21%. And that's in line with the year-to-date increase on the NASDAQ as well.
Well, that's good perspective to provide, isn't it?
Absolutely.
Especially when it seems like
green.
the sky's falling, right?
Absolutely.
Yeah, we were talking about earlier today, just if you took a poll out there of, true or false, are these numbers correct? These actual numbers year to date and over the last year. Our guess is that you wouldn't see a lot of accurate answers.
Mm-hmm.
So.
Yeah, there's definite volatility, but it's trending as it should and as it has in the past.
Absolutely.
All right, now for everybody's favorite part of our monthly webinars, the economic update, economic data section. As we've talked about, as we've done these, each week, each month, there's data that comes out that we stay on top of and pay attention to. And we've mentioned before too that it's kind of a mixed bag as you look through these, and you can look at things that would point you in a positive direction and things that would point you in a negative direction. So we're trying not to be overly optimistic, but also not overly pessimistic, but just looking at the data, relaying that to you and letting you know the things that we're keeping up with and staying on top of. So the first bullet point there with inflation, measured by the CPI, the Consumer Price Index, and the PPI, the Producer Price Index. This has been a positive trend since last July, which would have been numbers through last June. So we were at 9.1% year over year on the CPI last July, and the last number was 4.9% that was reported earlier this month through the month of April. So we have continued to slowly come down, bring that year over year number down. And we're encouraged, at least over the next couple months, that there's a good chance we'll see that number continue to come down. If we look back over the last 12 months, the largest monthly gains were in May and June of last year of 2022. And those months are going to be dropping off the 12-month numbers. So we are encouraged by that and hopeful that we'll continue to see the trend come down on CPI. As we have seen in the PPI numbers, the Producer Price Index, we kind of look at that as a leading indicator to consumer prices. because it's measuring wholesale prices at the producer level. And that topped out last March over 11%. And so we have again seen that index come down drastically as well. And so 2 months ago, that was 4.6%. Last month, it was 2.7%. And now this latest number reported this month was 2.3%. So that PPI is really getting in the range that the Fed is targeting. Now they're looking at the consumer prices as opposed to producer prices. But if we can make some projections and assumptions that producer price or cost savings ultimately make their way to the consumer, that bodes well to the trend on inflation.
Sure.
All right, employment and initial jobless claims. So we did have an employment report that came out at the beginning of this month through April, and unemployment actually went down slightly, went down to 3.4% from 3.5%. You can delve into the details. I won't get into all the specifics there. There's a lot of factors at play there, but we did create jobs, and we've continued to see a positive, jobs number as we've been going forward through this year. One thing that we paid attention to is the initial jobless claims, which has ticked up some. I'd say the first couple of months of the year, we were probably running around 200 to 225,000 in the weekly initial jobless claims numbers. The average over the last 4 weeks is in the 240s. So we've ticked up slightly. That's not concerning, but we have continued to see this trickle of layoffs announced that really started the back half of last year. So far, we haven't seen that bleed over into the unemployment rate.
And these would be people filing for unemployment benefits on a weekly basis, right?
That's right. Yeah. As far as the housing market, obviously, volume is down with both housing starts and with existing home sales. So they're both down in the 22 to 23% range if we look year over year. But one encouraging thing over the last week, the home builders sentiment survey came out, and that was positive for the first time in almost a year. So that's kind of a survey of those that are in that home building market, and their sentiment has been increasing over the last several months. We also, if we look at median sales price of homes, even despite the drastic increase in interest rates, median sales price overall in the country is only down 1.7% over the last 12 months. Mm-hmm. And the median price has come up actually over the last 3 months. So again, I would have thought that with rates rising as high as they have, we would have seen more impact on home prices, but we have not to this point. And then retail sales, we've talked all along about the consumer and that being important as we go forward, the resiliency of the consumer and the ability to continue spending, to continue to have economic growth. And retail sales were at 1.6% in the year over year in the last monthly report. That is lower than we've been seeing. So I think consumers are probably spending more on needs than wants, just due to inflation and things costing more, much more now than they were a year ago. Industrial production, that has been an area where we have seen negative numbers reported as we look at the back half of last year and the start this year, but we have had an increasing industrial production over the last couple of months. So that is something we continue to pay attention to. And then on the GDP, or the gross domestic product, this is just a measurement of overall economic activity. It is also one of the things we base whether or not we're in recession on. And so the first quarter GDP number that came out just after our last webinar, the first estimate was at 1.1% annualized for the first quarter. So that's less than the 2.6% in the fourth quarter of last year and the 3.2% annualized in the third quarter, but it is still positive. So we haven't dipped into the negative territory yet. And from the numbers that I've seen and read so far to date in the second quarter, I think the expectations are probably for a positive number for the second quarter. So we're going to talk about recession a little bit later on. That's probably the back half of the year if it is to come to fruition. So,
Well, you just mentioned positive retail sales and a healthy GDP. So
yeah. So if we take a snapshot as to where we are now, we're not in recession as we speak, but there's potential for things to deteriorate that could impact growth and have economic growth continue to slow. And that's what would have to happen for us to dip into recession. Speaking of that, the Fed's the last bullet point here, and the Fed has had a lot to do with what we've seen over the last year with rates increasing, and they've been trying to address inflation and address it fully so that we don't have to deal with it for an extended period of time. They did increase rates 25 basis points at their last meeting, the beginning of this month. If I had to guess, we may see a pause from them going forward. We do have the next CPI number comes out on the 13th of next month, and the next Fed meeting starts on the 13th. So I think if we get a lower inflation number, along with some of this other data, maybe the Fed is poised for a pause, but we will see. As we talk about recession, there's a lot of variables as we go forward. One of those is interest rates and the Fed, inflation and how that tracks the consumer and how the consumer spends or doesn't spend, and how the job market plays out going forward as well. I'm going to turn it over to Tara now to dip into recession risk indicators.
Absolutely. So what we're looking at here is a recession risk dashboard. This is put out by ClearBridge and something that we're tracking each and every month. JA went over a lot of the economic data, but the dashboard shows us 12 different economic indicators, and these are used to assess the risk of recession. If you've been with us, we've been updating you each and every month on how these have changed, sharing these charts. They are updated at the end of the month, and so there has been a few changes from our last webinar. And so if you look under current, which came out at the end of April, you'll notice that each of the 12 economic indicators are either signaling caution or recession. Just to give a little bit of history on the dashboard, for the recession indicators, once going red, the average is 3 months before we enter a recession. This obviously is not happening, and based on the current conditions, the dashboard signaled overall red in August of last year. In past recessions, we have had about 13 months before we actually entered into recession after the dashboard signaled red or recession. So hopefully that explains the average and then also long term. So this chart just indicates to us that the data is catching up with expectations. Like Greg mentioned, if you read also Greg's article in the magazine, this is deemed as the most anticipated economic downturn, most anticipated recession, I know, at least in my lifetime. The next slide here is just a look at historical recessions and what the dashboard looked like at that time. So as you can see in past recession, the 12 variables economic indicators have historically foreshadowed this looming recession. We're currently looking like historical times. I would pull out 2020 as this kind of stands out as an anomaly.
All right, next up is the conference board chart. which they call the LEI, stands for Leading Economic Indicators. It's the second tool we use to make a judgment on where we are in the US economy. And so what you're looking at on this chart from left to right is a blue line. And then you see those vertical gray shaded bars. There's 3 of them on the chart. The one on the far right is COVID and the impacts of the coronavirus there in 2020. And you can see the blue line signals a decline somewhat before the recession is actually called. So in each of these instances, except for the one on the far right, so for the other 2, there was a little bit of a headway. And so on the far right, we don't see any gray bars yet because our friends at the National Bureau of Economic Research have not called us in a recession. We did have 2 quarters of negative growth last year, but that wasn't enough for them to flip the switch on calling it a recession. Many of the pundits and many of the economists that we watch and follow are talking about possibly second to third quarter this year. So this is a chart that can help us with that. The data underlying the chart declined 0.6% in April. So that's the most recent reading that we have. And so the totals come to 107.5, which also followed a decline of 1.2% in March. And that overall leading economic index is down 4.4% over the 6-month period between October of last year and April of this year, which is a steeper rate of decline than its 3.8% contraction over the previous 6 months. So that would be April of 2022 to October of 22. So it's declined for a 13th consecutive month, as illustrated in that chart. The weaknesses were widespread, but only stock prices and manufacturers' new orders for both capital and consumer goods improved last month. So stock prices, you saw that from Tara's charts in the beginning, despite some of this concern around the LEI, prices still continue to go up. The conference board, which is nonpartisan, they're supposed to be non-political, they forecast a contraction of economic activity starting in the second quarter and leading to a mild recession by mid-year this year. So I think that's, for what it's worth, they're tracking this on a month-to-month basis as well. It's also important, I think, to note that no one can accurately predict a recession. 2008 obviously was the great financial crisis. You've heard the 3 of us talk about that in past webinars, and I don't think anybody called that one, even though it was the worst one. So who knows? What we do know is that there should be some contraction to economic activity, but even in spite of that, it's not a reason to avoid good quality investments. As we look to the future, in your news feeds, when you watch the evening news, you're probably seeing a couple of guys in this next chart. And I was a cartoonist at one point in my life. I don't have time to draw anymore, but if I did, I would come up with some designs for the heads of these 2 gentlemen that would probably give us a chuckle. And it has to do with the debt ceiling. This has been batted around a number of times over the years. And really the debt limit is the total amount of money that the United States government is authorized to borrow to meet its existing legal obligations, which includes Social Security. It includes the Medicare benefits that many of you are receiving, military salaries, government salaries, etc. Even includes the interest on the national debt, tax refunds, and other payments. Hopefully you've gotten all your tax refunds from Uncle Sam as of yet. It does not authorize spending on new commitments. It simply allows the government to finance what they've already agreed upon. And this would be agreements that they made in the prior past. Also, I think what's concerning to many people is that failure to increase this debt limit would have significant consequences. It would cause the government to potentially default on its obligations, which has never happened in American history. We have, however, seen government shutdowns, and typically it's over these spending authorizations. The most recent one, I believe, was in 2018. But we've also seen those in prior, both Republican and Democrat presidencies. And I believe there's been 10 of them going back to 1980. Most of those have just been a few days on a shutdown. But Congress has always acted to raise the debt limit. And that's what we really want to stress to the listeners and viewers of the call today is since 1960, Congress has acted 78 separate times to permanently raise, temporarily extend, or revise the definition of the debt limit. And that's been 49 times under Republican presidents and 29 times under Democrat presidents. And both congressional leaders of both parties have realized that this is an important thing to do. Our view is that they would continue to negotiate this out and come to some decision, much like they've done every other time. And I think McCarthy is scheduled to meet with President Biden later today around 5:30. And, we're optimistic that cooler heads would prevail and that the U.S. does not default on its obligations. Janet Yellen, our Treasury Secretary, has put a June 1st deadline on that. So, it's getting sort of late in the weeds on this. But again, I think it's, just really trying to go back to spending levels that were around the COVID era and try to have some fiscal restraint. And that requires compromise. I don't think you can do it any other way. The picture in front of you there is May 16th meeting last week. And so they're smiling, or at least it looks like Chuck Schumer's smiling. I don't know what they were talking about, but hopefully it was this issue, and hopefully we'll be able to get on the other side of it, and it will simply become a footnote in history around what is that, the 79th time that Congress enacted legislation to make those changes. So do we think that there's going to be this sky is falling around this issue, or that the U.S. government defaults on its debt? I personally do not. I can tell you that Jay and Tara don't either. And so we try to make plans around your financial lives based on what has happened. And we certainly take these issues like this into consideration. But if past history repeats itself, it will become a footnote in history. That's not to say that we are, that we're pleased with $31 trillion in U.S. debt, certainly not. But at the same time, there's only very limited things that we can control around that issue. But we are following it, we are watching it, and I think cooler heads prevail. That's what I know about the debt ceiling.
Yeah, the only thing I would add to that is that just given the current political environment and the fact that we're already talking about the next election cycle, I don't think either party wants a shutdown or the impacts of not coming to an agreement to be put on them. So for what it's worth, that I think that has some motivation there.
Yeah,
On both sides. All right, so this is kind of in line with the debt ceiling, but also we could fill in the blank with other things other than just the debt ceiling. But just I was able to snip headlines over the last week of just market headlines, either before the market, during market trading, after market, and really the biggest driver last week of the headlines of the day, and in many cases the market movement of the day, was this whole debt ceiling debate and where we stood. And so I thought it would be insightful just to go through if we look at last Monday, we had a positive day in the market as there was anticipation over negotiations continuing to resume. So that was the headline at market close Monday. Before market open on Tuesday, the futures had slipped. There was some disappointing Home Depot news, but debt ceiling worries. That was another reason for the down market futures. By Wednesday afternoon, we saw market jumping again as traders bet on a debt ceiling deal being reached. And these are live updates. Just had the chance to snip them as I saw them last week. Thursday morning, we went the other way. Dow slips as investors monitor debt ceiling talks and the Fed's next move. By Thursday afternoon, that S&P rises as hope grows for a U.S. debt ceiling deal. On Friday morning, there was hope that we would have a positive week. The futures were ticking higher and aims for a winning week. And then by Friday afternoon, Dow falls Friday after GOP negotiators halt debt ceiling talks. So you can see it's kind of like a whipsaw if you're just focusing on the headlines from day to day, from hour to hour. We did actually finish the week. It was a pretty positive week in the market last week, despite all of these headlines, about half of which were positive and half of which were negative, just based on what I snipped there. So, I mean, why do we want to pull that up and look at it? That's just 1 week, but it does give us a similar or comparable perspective to apply to longer periods of time. And so this chart goes back to 2018. So we're looking back 5 years as opposed to 1 week. You can see that the line there just tracks the S&P 500, which Tara's already talked about. You can see we're up, right, over the last 5 years. There's some volatility, there's ups and downs, and we've gone through things like U.S. government shutdown 2019. These were the headlines, right, of the day. COVID 2020. We had U.S. election concerns around, what was going to happen with the elections in 2020, 2021. We had rising rate scares. We had the Omicron variant for COVID. Russia invaded Ukraine last year, and then we've had this interest rate increases, recession fears, which, as we talked about, really started a year ago. So, we over time, at any point in time, you could take a snapshot, and there are things that are dominating the headlines in the news that really could cause you or bring you to the point of panic. But the prudent course of action is to remain calm and objective, especially with your investments, but really just with life in general. Turn off the TV. Let's focus on something other than the headlines of the day, because as we just saw, you could get, you'd be manic depressive if you're just looking at headlines and letting them determine your life and your thinking. So this provides you some additional perspective. And I think the important thing here is that the overall trend is up over the last 5 years. If you'd have put money in 5 years ago, despite all of these headlines and events that we've gone through. To look at it another way, the title of this is just the effects of panic attacks on the average investor or on average investors. You can see across the bar chart, these are investment returns over the last 20 years, average returns. You see real estate investment trusts being at the top of that list at almost 10%, US stock 9.5%, international 6.9%, government related bonds 4.4%, homes 4.4%, average investor 3.6%, and inflation 2.3%. So the measurement of this average investment number was done by a research firm. They were looking at fund sales and redemptions and exchanges each month, just as a measurement of average individual investor behavior. And so you could see there that if you are being impacted by all of these things, stressors on the market, the headlines of the day, trying to buy and sell, sell high, buy low. It really can impact returns. And that's where we see that 3.6% average investor return in comparison to these other returns over the longer term.
Well, and the reason for that is that investors would make a decision to sell when there is a panic attack or some negative news or even a recessionary time period, right, where markets are down. So the concern is there, no doubt, but that's the wrong time to sell. That would be a time to buy more.
That's right. Yep.
Based on history. I mean, the consumer is really this 70% of the equation, and I don't think the consumer is going to stop spending. Sure, we'll go through these recessionary dips and, those types of concerns, but it doesn't make sense to me to sell on a long-term account where you really should be buying more at a discount.
Classic case in point are the numbers Tara looked at, over the last year-to-date numbers, or even over the last 12 months, even in spite of recession being in our lexicon, well before, we started off this year, right? So.
Well, and it's not an unnatural impact of the economy that we have. I mean, we've always had recessions, but it's not a reason to no longer invest. It's just a reason to understand you have to wait through it. And it's really a good buying opportunity. And if you don't have the fortitude to buy more, I understand that, but don't sell out of good quality securities simply because the market's priced them less. It's not a reason to fear.
Agreed. Tara's going to speak to some other reasons not to fear.
Absolutely. So Greg discussed some of the specifics around debt ceiling, and what I wanted to take a look at was kind of the before and after effects. So the most recent standoffs, we'll call them, were in 2011, 2013. And you can see on the left chart, the returns is for US stocks 3 months prior were down by 5%. But then 1 year, 12 months later had increased by 9.7%. Something similarly with bonds, 3% was up 3% 3 months prior, but then 12 months, 1 year after was up 6.9%. And so we're seeing a significant increase after these debt ceiling standoffs or concerns. And then on the right-hand side, you see 2013, US stocks were up 3.3% 3 months prior, and then a year later, up over 20%. And then US bonds in 2013, 3 months prior to debt ceiling conversations, up 0.6%, and then 1 year, 12 months after, up 4.4%. So definitely positive outlook going forward. And then we talked about the Fed pausing rates. And so what we wanted to take a look at was historically, overall with the markets, what do they do when the Fed pauses their rate hiking? And as you can see, there is an average increase, and this is kind of broken down by market cap, but also US, international, and emerging markets. They've all been positive after a Fed rate hike pause. And so large value, as far as market cap, up 27%, US stocks 24.3, small cap 23.3, and so forth. Even international and emerging markets up double digits. And then the chart on the right, the data actually for this scenario goes back to 1994, but you can see how they've calculated the overall average.
Insightful, very insightful.
I think it's good historical data. It's interesting.
Yeah, and it's not a predictor of what's to come. Obviously,
Right.
We don't have a crystal ball, but it is good information to fall back to. Also, this shows up in the bond markets as well. Rising interest rates impact bond prices negatively. So as rates go up, bond prices go down. But when the Fed rate hike pause happens and we look out, this one is going back to February 94 and just seeing what that average 12-month return is like in the different fixed income categories. Money market fares out the worst at the lowest end, but the core US bond market does the best. In that right-hand side, the specific periods, you can look back to each of those periods. There's 5 different ones going back to the 94 data, and you can see how those different returns play out. Not every one of them was positive. So high yield, for example, after the May 2000 pause was actually down 12 months after that. But historically speaking, most of that data follows a positive dot point, and is somewhat interesting to take a look at. So whether we're at that point now or soon to be, I can tell you that short-term rates looking out 18 months are actually lower than the rates we can get for 12 months. So I think the futures market is looking at that already. So, and then if we take a look at overall cash, we see money markets reaching a historic peak. And this is data just looking back to 1996 all the way to March of this year. And the left-hand chart is reflective of the peaks of those money market balances across the US. And so, for example, January 2003, it was at 2.3 trillion and then dropped back down. January 09, it reached 3.8 trillion. And then most recently, March of this year, it reached 5.2 trillion in terms of cash in money market accounts. As we look at a 3-year performance cycle following this peak, in US stocks, those have been positive in each of those peak cycles. The overall average going back to 1926 by the S&P 500 has been 10.2%. That's the annualized return averaged over that time. And you can see where money market rates fall after that time period, which would lead us to believe that if there's a pause or even the Fed decides to cut rates, if we do in fact go into a recession, that money market rates would start to decline. It's not a place where you would want to camp out to ride out a storm any longer than just a few months per se because of this data. So again, I don't know what the future brings, but just showing you some perspective around these historic peaks, I think is important.
So you're telling me not to sell out of everything and go to money markets right now?
It's not that compelling right now to do that. I think you'd be making a mistake. You
Yep.
should have money market and cash as part of your overall investment objective and should be a part of your plan. Normally, when we do financial planning calculations, Tara, tell us how much cash we advise clients to have.
In their investment account?
Well, in their overall financial planning.
That's a loaded question, Greg, because it depends on individual situation. If we have someone who's going to have a large expense in the next couple months, it's very individualized.
Sure.
I would say at minimum, short term, 3 months, upwards of, getting close to 12 months, depending upon situation.
Yep. And that's of living expenses. So we'd never advise you to have zero cash.
Right.
But then we're also not going to say, hey, now's the time to hang out in money market assets or gold or any type of hedge like that, because it's just too difficult to predict the bottom, right?
Yes.
All right. We've had this question come up some with clients, and for those that haven't asked it, I'm sure it's on the minds of many others of you, but should I be concerned about AI and ChatGPT? Again, going back to headlines, even just over the last week, Google Cloud launches AI-powered tools to accelerate drug discovery, precision medicine. So there's one side of this that's going to drive innovation and change as we go forward. with things like medicine, drug discovery, those types of things. We also saw the OpenAI CEO for ChatGPT. He came and talked with Congress, with lawmakers last week, and a lot of the feedback from the lawmakers were that there's a lot of positives there. Now, that being said, there are also challenges that there's another side of that with new technology, if used in the wrong way, or even if things aren't developed correctly or appropriately, especially with the technology we're talking about today, where it kind of learns on its own, which is, it's just unlike prior to now, where you program in what you want something to do and it does it. Here we've got technology that's actually learning how to do new things or do things differently on its own. But there are definitely concerns around things like security, privacy, biases within the AI, confidentiality, these types of things that I think it is going to be important that those things are addressed and harnessed and stayed on top of. And there's always going to be folks that try to use technology or whatever resources they have for the bad as opposed to the good. So just as we've seen, folks trying to scam folks become more adept at what they're doing, I think, that is something to pay attention to and be on guard for as well with AI. I think the far out scenario of robots like taking over humans, I don't think that's where we're headed. But we've seen sci-fi movies with that. And we were talking, the team here today, just about, it was 6 years ago that Sophia the humanoid was developed, who can converse, on a one-on-one level with folks very capably. You can go check out YouTuber and watch interviews with her. But she is the first official robot citizen of Saudi Arabia. But we had, this is 6 years ago, and we haven't seen her multiply in an attempt to take over, the world yet. So I don't think that's what we're facing. It is more those things of, how is this technology used? Are there controls around it? Are we addressing and staying on top of those concerns? So we are paying attention to those things. And as we know more, as we learn more, and as things continue to be developed, they will be a part of what we are staying on top of.
Well, and it's not really new either. IBM had Deep Blue that beat Garry Kasparov, the world chess champion. I believe that was 1997. And they developed Watson, who played Jeopardy in 2011. So these tech developments continue to happen. And I think that's just something that we would expect as we go forward. But it's definitely made headlines most recently.
Well, and the other point around that is, for folks that would be just pessimistic about the future of the US or just in general, what is going to bring us out of a slower growth environment? I mean, ultimately, it is innovation that America has been the driver of in the world, that we would look for that to continue to be a driver going forward, that would put us in a place to recover from where we are currently, and even if, for whatever happens over the next few months.
Definitely.
All right, we're going to shift gears a little bit here. Each month we've been highlighting a financial planning topic, and this is just in hopes that we can share through these webinars topics of interest, but also of importance. And so this month's topic is estate planning. These items we put together collectively. These are things that are brought up in meetings, and we also see with working with clients. Disclaimer, we're not attorneys, we're not providing any sort of legal advice. We just have some considerations we want you to think about. So first and foremost, we'd like you to consult attorney, specifically an attorney that specializes in estate planning. We don't suggest meeting with a criminal law attorney in order to draft up your trust documents. Same way we wouldn't recommend a orthopedic surgeon, for open heart surgery. So we want them to specialize specifically in estate planning, and we are glad to introduce you to a local estate planning attorney as a referral. Your planning needs can include a will, power of attorney, directives, or potentially even the establishment of a trust. We do recommend that you're keeping your estate planning documents in a location that a trusted person is aware of. And it's also a good idea to keep your financial records in a similar location. We do want you to have a basic understanding of how assets pass. We've had many conversations with clients and they say, oh yeah, my will take care of that. And just not understanding that certain accounts follow different disbursement laws or procedures. And so we just want you to have a basic understanding of that, which leads us to make sure that you're verifying and updating beneficiaries on your accounts. We say at minimum once a year, let's go in and let's take a look at this. Also, if your desires, your circumstances, your family needs have changed, it's potentially time in order for at least to verify or update at that time. And then the last thing here is we don't want you to hesitate on updating any of these estate planning documents or even updating beneficiaries, something like if your family situation or desires have changed, please take the time in order to update this. Next is 2 items for survivors. This is very important to us that we pass on. Some assets will receive a step up in basis or tax cost at the death of the original owner. And you can see here that if the asset qualifies, it would be included in the decedent's estate. The beneficiary's basis would, at the time of death, there's a few other rules that are more specific, but generally at the time of death, it would increase to fair market value. So then when the survivor then goes to sell the asset, the tax cost is higher, making the gain minimal or at least smaller. So that's important to know about and be tracking on. And then the next thing is there's been some recent changes with regards to inherited IRAs. So it's really important to seek professional guidance just to get information on that proper distribution, first to avoid penalties, but also sometimes there's opportunities for tax strategies to implement here. And then lastly, the IRS has some proposed regulations. We expect to receive official guidance later this year, but we want to at least provide an overview of what this looks like. These are specifics with regards to what we call required minimum distribution. And so if the decedent died before starting required minimum distribution, you'll see here it says RBD, which is required beginning date. Those go hand in hand. First, we look to see if they died before that date. Next, we go to look and see if it's a qualified beneficiary. So usually it's a spouse or non-spouse. There are other circumstances. And then that would lead us to our next question that we would answer is this an eligible designated beneficiary? So for example, if you inherit your non-spouse and you inherit an IRA, you may fall under what's called the 10-year rule. And there's also some pending guidance on the 10-year rule. What we know now is the IRS says you have to take all of the money out of that IRA by the end of the 10th year. And so the initial thought was we have control and we can be strategic about when to take the funds out. The IRS has come back and said, well, maybe that's not exactly what we meant. So again, waiting on some official guidance, and it may come down to, or it looks like it may come down to, even on those 10-year IRA beneficiary accounts that you may have to take a small amount out each year and still empty the account by the end of the year. If the beneficiary is a surviving spouse, we have some flexibility on this. If you inherit as a spouse an IRA, you can roll it over into your own personal IRA, and then this would push back those required minimum distributions to the age in which the IRS at that time says you have to start taking money out. We do have a very important conversation first, and that is, as a spouse, as a beneficiary, do you need access to funds now? Because we have the ability to leave the money in a beneficiary account, and you can take those required minimum distributions while you need the funds before then rolling that into your own traditional IRA. And when that would be important is if the spouse is younger than age 59 and a half, that's the age in which the IRS says you can take money out of a traditional IRA or tax deferred IRA without penalty. And so there's some ongoing conversation. We just wanted to provide you with an overview and introduction to this as well.
Yeah, especially because if the proposed changes are implemented, it does impact clients, those that are under the 10-year rule that may have to start taking money out, whether or not they plan to,
But it also takes into account planning considerations for someone who might be a single individual naming their children as beneficiaries of a retirement account, and do they pass along the tax burden to their children, or is there a better way to handle that while they're living?
Mm-hmm. Yep. All right. Well, we're bumping up against time here, but we always like to end on biblical wisdom and truth. And so the word of God is where we look to just for truth and wisdom and encouragement and guidance. And I think we looked at this passage probably a year ago, maybe a little more. But it's a great reminder. Just looking at Philippians 4:4-7, we read starting in verse 4, rejoice in the Lord always. Again, I will say rejoice. Let your reasonableness be known to everyone. The Lord is at hand. Do not be anxious about anything, but in everything, by prayer and supplication, with thanksgiving, let your requests be made known to God. And the peace of God, which surpasses all understanding, will guard your hearts and your minds in Christ Jesus. And, it is in our human nature just to worry and be anxious about things, but it's only through the peace of God and through Jesus and salvation that provides really true peace, and peace that, as we read there, will guard our hearts and minds in Christ Jesus. And so we just want to encourage, first of all, ourselves, but encourage you guys in that, but also just comment that we'd be glad to talk to any of you more about that as well. So that's what we'll leave you with this afternoon.
Yeah, so thank you for joining us. As always, it's our privilege and pleasure to bring this to you. If you found it helpful, that's great. We look to letting you use this for friends or family or your loved ones, share it with them. Also, as meetings come up this year, if there are issues like planning considerations that we talked about today that are on your mind, let us know. We do depend on you during the interim time periods between these meetings to reach out to us if your circumstances have changed or if something's going on in your life. But always rest assured, we're concerned about your well-being and want to help you any way we can, as well as those you care about. So we look forward to seeing you again in June when we have our next one of these. In the meantime, I know it's graduation season, so maybe you've got grandchildren or friends of yours that are graduating from either high school or college. And if so, we extend congratulations to you and best wishes to them as well. And we look forward to seeing you at our next meeting. Take care.
Take care.
Bye.